We know from the CB Insights, they've gone through 150 companies that were angel invested, and we see a bunch of reasons that the companies failed. These are angel invested in companies, so they're one of 30 that were invested in that they thought were great deals, and still most of them failed. And of the ones that failed, they typically failed because they didn't understand their market, they had a team that didn't do what they needed to do, or they had a product problem. And so those are places we want to dig in deep when we're doing our due diligence. On the other hand, companies succeed where they're in the right flow of the market, of where the market is going. They catch a wave in the market. They have a good, strong team. That idea has some critical component that's impressive by itself. Somewhere down inside that idea, there's a matching business model that makes sense, that actually drives it. And then having funding sometimes makes a difference, but a lot more infrequently than people tend to think. Funding is usually not the barrier to a success for a company. Typically, it's the market and team. Sometimes it's the business model. Sometimes it's the idea. Rarely, much less frequently, is it the funding and access to the funding as a mechanism for succeeding. It may be a mechanism for growing, but not necessarily for a business succeeding.
And I'm going to dwell on this one for a second. So Bill Gross is the founder of Idealab, which is it's an older model that doesn't get copied too often. It's a company factory. So they create new companies. I don't know where they source their ideas, but the ideas show up and they put a team around it and they work on that and they build companies inside the lab. And when they feel like it's ready for the real world, they'll go out and get some more funding for it. They've been doing that for 25 years, at least. It could be 30 years by now. They've produced multiple public companies, multiple billions of dollars of corporate value, over 200 or 300 companies by now. And Bill Gross never talked about anything until this TED Talk, which was just a few years ago. And so he finally said, it's time to look at the data. What makes this successful company successful? And so just flip back a second. A lot of people look at what makes companies fail. That's been looked at over and over and over again. This was the first time I saw a really good analysis of what makes companies succeed. And when you ask investors what they look for, they'll say it's team, then idea and business model and opportunity size and a few other things. But first and foremost, team. Bill Gross is coming back and saying, yeah, team is important, but it's nowhere near as important as timing. Well, I've been doing startups for almost 30 years as well. You have almost no control over timing. It's a big factor of luck in there, because by the time you get to the point where your startup is ready to succeed, where it's in the market, it has a product, it has a big enough staff to go and grab some opportunities. Well, by then that's 2 or 3 or 4 or even 5 years down the line. And so the founder had to predict the future 3 or 4 or 5 years in the future to hit that timing just right. So there's a ton of entrepreneurs out there right now who will do blockchain anything because blockchain's new. It's in the news. It's going to be huge any day now. And maybe it will. But I can't tell you whether it will be huge in 2020, 2021, or 2028. And I lived this personally. I did my first company in 1992 because there was an article in a magazine in 1991 telling me that PCs were going to peak and the next thing was going to be tablet computers. And they were right. In 1991, they were right, but their timing was wrong. They thought it was going to happen in 92. There wasn't even a tablet that launched in 92. We had to wait until 1993 until we had a tablet to buy. But no tablets really sold until 2010. 2010 was when the iPad came out. So this magazine was wrong by 18 years. And I was wrong by 17 years. And there was no way my company was going to last 17 years waiting for the market. But we were right. It's just a matter of timing. So that's one of those factors out there that you can, as an investor, say, it looks like this might be a good timing for what they're doing. But no one can actually predict it in foresight. You can only predict it in hindsight, which is a shame. As you can see from all this data, no one, no matter how professional you are, no matter how much due diligence you do, you actually won't predict more successes than failures. You will fail more often than you succeed in investing. And the saving grace is that the winners win enough. They get big enough to make up for the losses.